Greetings and welcome to our simplified stock investment course. So in this lesson, we're going to talk about the balance sheet, assets, liabilities, and the margin of safety. So what is an asset? An asset is anything that puts money into the pocket of the business or something that adds value to the business. Example, if the business has books that it sells, it earns royalties. If it has songs, it sells the songs and earns royalties. If the business owns land or a house, it can rent or sell the house to get money. If the business has stocks that it owns, it can be given dividends at the end of the year. So those are examples of assets. Next, to look at liability. Liability is something that takes money out of the pocket of the business. For example, a mortgage. If the business takes out a loan, uses the loan to build land, at the end of the year they need to pay that mortgage or that loan. Then account payable. If a supplier supplies money to the business and the business agrees to pay him later, that's a liability. Then next we look at equity. Equity is the difference between the assets and the liabilities, or rather the amount of money that, the amount of capital owned by the owner of the business. For example, if the assets are worth $100, liabilities amount to $20, the equity is 80. Then we mentioned earlier that equity per share is known as book value. I hope you remember that. Then next to look at the margin of safety. If the stock price is $25 and the equity is 10, the margin of safety is 15. If you were to buy a business for $25 and the business went bankrupt the same day, you will lose 15 shillings, or rather $15. So the margin of safety is used to assess risk. I hope you understand. So with that being said, thank you for watching. See you in the next lesson.